Knowledge is power. Make an impact by learning more. Call us right now for more help at 866-945-8070. Bookkeeping basics with QuickBooks Online. There are 5 account types in any set of books, in any accounting system, in any country, in any part of the world. 5 account types: assets, things you own or have rights to; liabilities, the things you owe, the things you're obligated to pay; equity, which is actually the difference between the two, or the net value of the business, right? Assets minus liabilities, what you own minus what you owe, equals what the value of the business is, what the business is worth at any given moment in time. Then we have revenue and expenses, which most of you are probably very familiar with. Revenue is what you earn from the sale of products or services. Expenses are the things you have to pay for to keep the business going in order to earn that revenue, right? So you need to understand this so you know what's going on behind the forms in QuickBooks Online. Knowing what's going on behind the forms will help you get better at using the forms so you understand what the impact is when you post something. Understanding what the impact is when you post something will make you better at thinking about a transaction and how to post it with an eye towards what it will look like on the balance sheet and the profit and loss. Bookkeeping is about recording transactions in a way that will properly disclose the financial position of the company when someone reads the balance sheet and the profit and loss. Your job as the bookkeeper is to paint the complete and accurate financial picture. So debits and credits might seem like advanced stuff, but they aren't. In fact, they're the very foundation, the first thing you need to know before you take on the task of doing the books. So let's look at some debits and credits, then let's take a look at some transactions, right? And of course, here I have a sample QuickBooks Online company, and as you can see, everything's blank. I've got my balance sheet for all dates, and I've got my profit and loss for all dates. And as I always love to do, we're going to post some stuff, and we're going to update these financial statements so that we can see very specifically where and how they impact these financial statements. That's what's really important. It's probably more important than ever now because there's less real bookkeeping to do because so much of this process has gotten automated now over the years, and it will continue to get even more and more automated. There will be less and less coding to do, less and less babysitting required when we're using things like bank feeds to get transactions from where they took place in the bank accounts and credit card accounts to where they end up showing up on the books ultimately. So again, we have 5 account types. We have assets, and here's some examples of assets: your bank account, your accounts receivable that you have rights to collect, and any other current assets. If you've made loans to employees or if you've loaned money to others, those are all going to show up in your assets section of your balance sheet. Liabilities, accounts payable, credit cards, payroll liabilities, loans that banks or others have made to you that you have to pay back. And then equity is, depending on the entity type, the language will vary, but you have owner's equity or shareholder's equity or shareholder contributions or owner contributions and distributions and capital or member equity if it's an LLC. Those are the kinds of accounts. And then, of course, we see retained earnings, and you'll see in any balance sheet the net income line. That's just the closing of the current period net income that comes over from the profit and loss, which is ultimately how we get that balance sheet to balance. And then, of course, revenue, like I said before, sales of products and services, and expenses, just some examples: advertising, office supplies, internet applications, rent, those sorts of things, right? So when you go to school for accounting, the very first thing you learn pretty much in your first semester are how to use T accounts to describe transactions. So before we even get into using any software, again, it's important to understand how these transactions are going to flow, where are they going to impact the financial statements, which ones. Is it going to hit the balance sheet? Is it going to hit the P&L? Is it going to hit both, right? Very rare that a transaction won't touch the balance sheet in some way, shape, or form. You certainly have transactions, though, that are only on the balance sheet and don't affect the profit and loss at all. And you're going to see an example of that right here as I go through this just handful of transactions to show you. So the first thing we do when we open up a business is we're going to deposit, let's say, $1,000 just to get the bank account open. So that's our first transaction. And what I've got in the spreadsheet, and there's going to be a link to the spreadsheet in the blog post wherever you're watching this, is a little mini trial balance here, right? So this will help you if you're practicing to make sure that you've got things balanced properly, right? So if I'm receiving $1,000 into my bank account because I've made a deposit, then that's going into the bank account. And bank accounts or assets are actually increased by debits. Assets are where we get confused with debits and credits because the banks have us thinking it's the other way around. Because when the bank debits your account, they're taking money away. But in reality, the bank is sort of giving it to you from their own perspective. The truth is, when in accounting, debits increase bank accounts, right? So that's the one thing you have to immediately, if you're not familiar with this stuff, get your head wrapped around. So we're going to go down to the bank account in transaction number 1. Here's the bank account, and we're going to debit 1000. Okay, $1,000 going into the bank. And if I'm contributing this money myself, I just gave you the hint for where that goes. If you go back to your account types guide, I'm contributing money. That's owner's equity. That's an owner's contribution into the business. So let's go back to my T accounts, and here's my equity, right? And I'm again using transaction 1. And equity accounts work the opposite of asset accounts. So equity accounts are increased by credits. Okay, and some of this is just memorizing. In fact, I'll give you the quick tip on how to remember what's debited, what's credited for an increase. It's real simple. Just remember that assets and expenses are increased by debits. Assets and expenses are increased by debits. Everything else is increased by a credit, right? So assets and expenses are debits, and then liabilities, equity, and revenue, the remaining 3 account types, are all increased by credits. So equity increased by credits. Okay, now if I go over to my little mini trial balance here to the right, you can see I'm balanced. I have my bank account for $1,000. I have my equity account for $1,000. Down here confirms that I'm completely balanced, right? So really, really helpful. And in my opinion, important to understand this. Now we can go into QuickBooks Online and let's record a transaction, right? So I'm here on this tab where I've got the balance sheet open. I'm just going to go up here to the Quick Create. We're going to make a bank deposit. And we're going to put it into, I don't know why, I'll just, actually we have just the one checking account, 1, 2, 3, 4. Let's backdate this. Let's say we opened up the business in the beginning of the year, and we'll date this January 1st. And this is going to be, let's see what I have here. Shareholder contributions, perfect. Amount, 1,000. Now remember that you saw a minute ago, there's nothing on the balance sheet. And if you go back to your T accounts, you can also figure out that we're hitting a bank account and we're hitting an equity account, right? So are we hitting the balance sheet or the profit and loss? Both? Neither? Well, you can go back to your account types and figure that out, right? Because if I'm hitting the bank account is where the money's going into, and the equity account, shareholder contributions, is the offset or the other side of it, right? These are both balance sheet accounts. Assets, liabilities, and equity are on the balance sheet. Revenue and expenses are the profit and loss. So everything we're about to record is only going to affect the balance sheet, nothing on the profit and loss. So let's run the balance sheet from this tab so we can record the deposit and then update this to see the impact, right? So I have the shareholder contributions for $1,000. It's going into the checking account. The target, this is the source account. The target is the account that's down here. The target account is shareholder contributions. Let's say save and close. And it takes me right back to the balance sheet because that's what I had up before I went to create the transaction. So we didn't even need to go to the other tab. Right away, I can now see I've got $1,000 in the checking. I've got $1,000 in shareholder contributions. If I go back here and run my profit and loss, we've got nothing because nothing we did in that transaction had any impact on the profit and loss statement. Now, it's like many things in life. If you're able to predict what should happen before you record your transactions, it's a big help because then you know if you've done something wrong, if you've made a mistake. If you post that transaction and then run your balance sheet and you see, okay, the balance sheet looks exactly as I expected it to, then you know it's likely correct, right? If you did something wrong, if you accidentally chose the wrong account, you would see something other than what you expect, and that's a clue that you should look into it and see, wait, where did that go? Why didn't it show up in shareholder contributions? Maybe I was going fast and accidentally picked up the wrong account. So you know to check those kinds of things, right? So if you go into something with an expectation or a hypothesis about what it should do, how it should impact things, then you check and see, did it impact things the way you expect? Really, really important thing that I teach all bookkeepers that I work with and teach in terms of how to go about processing bookkeeping transactions. Always go into it with an expectation about what it should look like, so that if you do make a mistake, if something does go wrong, it sort of stands out to you that something doesn't look right. Okay, and if you're watching at home, just pause the video right now, get caught up, get this template downloaded, open up your own sample QuickBooks company, and try this. Make sure that you can get at least as far as I've gotten, which means you have a balance sheet that shows $1,000 in a bank account and $1,000 in shareholder contributions. Nothing more, nothing less. This is a perfect opportunity to pause the video and get caught up. Now we're going to look at the second transaction. Okay, the second transaction says I'm going to invoice a customer for services rendered, right? So what I'm trying to do here is give you kind of the complete cycle of the business, right? So we started the bank account off with some money, then we're going to invoice a customer, then we're going to get paid, and then we're going to spend some of that money. This way we kind of cover everything. Obviously, it gets much more complex than this, but this is bookkeeping basics with QuickBooks Online. So we're going to invoice a customer. Going back to my account types, if I'm invoicing a customer, I'm going to increase an asset account called accounts receivable, right? Because when I invoice the customer, the assumption is they're going to pay me later, right? Maybe I'm giving them 30 days to pay me. So invoicing a customer is going to increase accounts receivable. Remember that assets and expenses are increased by debits. So let's just say increased by debits. Expenses are increased by debits. Everything else increased by credits, okay? So we're going to increase accounts receivable, and I'm also going to increase, I'll give you a second to take a guess before I tell you, some form of revenue, some form of income, right? I'm increasing my sales of products and services. So I'm going to debit accounts receivable, and I'm going to credit the product or service, the sale, some income account, right? Let's do that here in transaction number 2. Here's accounts receivable, transaction number 2, 10,000. On the debit side, debits increase assets. I'm increasing accounts receivable, right? And then I need some kind of services or income account. Look at that. It's right here. How handy. So I'm crediting the income. Credits increase income. Debits increase accounts receivable. Bookkeeping has this sort of beauty to it in terms of how things balance so perfectly, right? Debits always have to equal credits. Let's make sure that we've accomplished that. Looks like we're good. Right, and here we go. Accounts receivable is lit up for 10,000. Income is lit up for 10,000 there. So we know we're in balance. Now let's go record this in QuickBooks Online. So let's go back over here to my balance sheet. I'm going to create a new invoice. That's going to be under customers. Anything having to do with a customer is going to be under customers. Invoices have everything to do with customers. Okay, and we'll just pick a customer from here. We'll pick Barry Allen. I am kind of a comic book nerd. And we'll pick a product or service. We'll pick services. We're going to bill Barry. Since he's very fast, we're going to bill him a lot. We're going to bill him 10,000 for being super fast. And you get extra points if you comment and tell me who Barry Allen is. Hopefully, most of you know that by now, especially with all the TV shows and whatnot. Anyway, I digress. So when I hit save and close on this, what's going to happen again? Let's predict it. We already predicted it here. We're going to increase accounts receivable, which is on the balance sheet. Right? Let's go back here. We're going to increase accounts receivable, which is an asset on the balance sheet. And we're going to increase revenue, which is an income account or a revenue account. So let's do this. Found on, because this will be a great little guide for you to keep handy as you're doing and practicing this kind of stuff. So this is all balance sheet, the first 3. This is profit and loss, the last 2. Okay, so we're going to increase revenue, increase accounts receivable. So we're going to see a change in both the balance sheet and the profit and loss this time. And again, if you feel I'm going too fast, some people tell me that, pause the video, go back, review this, make sure you follow. I'm giving you the templates, so it should be, I think, hopefully really easy to follow. and understand what I'm doing here. And again, I'm speaking from the experience that I've had with similar videos that I've done in the past and the comments that I've gotten. So I know that to some of you who have no experience with bookkeeping, this might seem really advanced, but I promise you, this is the first stuff you learn if you go to school for accounting. And the reason is it's the foundation of all of it. So it's important to know. Right? If I just taught you how to record an invoice in QuickBooks, that's not really going to help you because you're not really going to understand what's really going on when you do that. Okay, so that's what I'm trying to do here. Let's say the invoice happened, after the first of the month. By Friday, we opened up the bank account, we worked hard all week, and we got our first client, and it was Barry Allen, and we're billing him. When I hit Save and Close, it's going to increase my accounts receivable on my balance sheet for $10,000, and my profit and loss is now going to show revenues or income of $10,000. I'll hit Save and Close. There's my accounts receivable. Let's go over to my profit and loss. There's my accounting fees for $10,000, right? So that takes care of transaction number 2. The next thing that we hope happens after we invoice the client is that we get paid, right? Now, Barry Allen, being who he is, should pay us really fast. So let's get a payment from Barry Allen. But first, let's see what's going to happen when we do. When I get a payment from somebody, I'm going to close out that accounts receivable, right? Because he no longer owes me the money. So I have to remove that $10,000 from accounts receivable or reduce accounts receivable by $10,000. So I'm going to decrease accounts receivable. So follow the logic, of course. If, that's not what I meant to do. If a debit increases accounts receivable, obviously a credit decreases accounts receivable. So I need to credit accounts receivable by $10,000 because I need to show that Barry's paid me now, right? So I'm going to credit accounts receivable or reduce accounts receivable by $10,000. What's the other side of that is, and it should be pretty obvious, but think about it. I'll give you a second. Well, he's paid me, so I've received money. Maybe he sent me a check. Maybe hopefully these days it's 2018. Hopefully he paid me online by some way, shape, or form, ACH or credit card, right? So I'm going to increase my cash. So I'm actually moving things around within the same section of the balance sheet. I'm reducing one asset and increasing another. I'm getting rid of an accounts receivable and I'm converting that to cash. I'm increasing my bank account. So again, everything here is happening on the balance sheet. We're going to take $10,000 out of accounts receivable and put it into the checking account, and here's what that looks like. Let's go in. Wait, I didn't record it in the T accounts, did I? Sorry. Yes, I did. I digress. All right, so under customers, we're going to receive payment. Okay, this is going to be from Barry. All right, and Barry's super fast, so he pays us on the same day he was invoiced, right? Because he can just flash over here with a check in hand or something. So no need to go to undeposited funds. We'll go straight into the checking account where it's going to get deposited. And this is pretty much everything we have to do. We can pick the payment method. We can say check. Let's say he just ran over here with a check real quick. Save and close. And sure enough, I now have $11,000 in my checking account and nothing in accounts receivable, right? I did not show the receive payment part here. I knew I was missing something. So let's do that here and now. So we're going to add in transaction 3, we received the payment. Let's go down here, accounts receivable in 3. We reduce it. So accounts receivable is now 0. Here we increase bank account. Bank account now has 11,000. Accounts receivable is now 0. Let's see if that checks out over here. Accounts receivable 10,000 in debits, 10,000 in credits, zeros out. Bank accounts 11,000, equity of 1,000, and income of 10,000. So that's how it all balances out quite beautifully. Okay, so accounts receivable, when we get paid, we're decreasing accounts receivable because we're converting that account receivable to cash, decreasing accounts receivable, increasing the bank account. Let's see what we're going to do next, because now we've got a little money, so let's go buy a computer, right? Maybe we're using our own personal computer because we didn't have money yet for the business. Now we're going to go buy a computer for the business for $2,500. So let's go back here to the account types. If I'm buying a computer for $2,500. The question, of course, is how am I going to pay for it, right? And I'm just filling in my headers here so that by the time you get this, it'll be nice and beautiful. So if I'm paying for something, I'm going to be using up cash. I'm going to be losing cash. I'm going to be spending it, right? So it's going to come out of the bank account, right? Unless I put it on a credit card. So again, depending on how I paid for it, that's really important. So I love when clients come to me and say, hey, Seth, I just paid for a computer. And I say, great, how'd you pay for it? And they have to stop and think because they weren't prepared to answer that question. But then they kind of realize it's kind of an important question. I need to know, did we take the money directly out of the bank account or did we put it on a credit card? Because if we took the money directly out of the bank account, then we're going to credit a bank account because credits reduce assets. Since debits increase them, credits reduce them. So I would need to credit a bank account to reflect the fact that cash has now gone out of the bank account to pay for the computer. On the other hand, if I put it on a credit card, I would actually credit the liability. In that case, the credit increases the liability. Credits increase liabilities. I would increase a credit card balance because now I owe money to that credit card company because I haven't actually paid for it yet. Right? So I need to know how it was paid for. Let's assume, to keep things simple, that we're paying for it with a debit card, which is the same thing as writing a check, just electronic, right? Debit cards means the money's coming straight out of the bank account. So we're going to debit the bank account, and we're going to credit computer expense, right? And since it's $2,500, it's a major purchase, so we're actually going to debit a fixed asset account called computer equipment, right? So it's actually not even an expense when we're spending that kind of money on a piece of equipment that's going to be used for probably more than a year, okay? So let's take a look at what this looks like in our T accounts. So we're buying a computer for the office. We're going to pay for it right out of the bank account. This is transaction number 4. $2,500 being spent now comes out of the bank account. Okay, and then the other side of that is going to be a fixed asset for computer equipment. So let me just see where we might have that. And I might need to, I'm just going to change the next one here. That's the beauty of these. I've got them set up dynamically. So we're just going to change this one to computer equipment. And this is transaction number 4, wasn't it? Number 4, $2,500 for a computer, right? $2,500 coming out of the bank account. Computer equipment, I was scrolled over. I could have used this one. This was prepaid. Something. All right, transaction number 4, computer equipment. We're going to do this as a fixed asset. It's a debit for $2,500. Right, we're increasing an asset account. We're basically converting cash to a piece of equipment for $2,500 goes to computer equipment. So we're debiting one asset, we're crediting another asset. This is yet another example of where all the action is happening on the balance sheet. It happens a lot. You'd be surprised. Most of the bookkeeping really does take place on the balance sheet in most cases. Right? We're balanced 23.5 and 23.5. We took money out of the bank account here and we put it into a fixed asset account over here called computer equipment. Let's record this in QuickBooks Online. Okay, I'm going to create a new transaction. It can be an expense or a check. A check just means it has a check number. Expense means it maybe was a debit card or anything that's not a check, right? So I generally just defer to the expense. This might be like Best Buy. Right? I'll add Best Buy really quick as a vendor and save it. And we'll say this happened on January 15th, right? Computer equipment. Notice it's here as a fixed asset, $2,500. Okay, so when I hit save on this, we're going to see the bank account balance going to get reduced by $2,500, and there's going to be a fixed asset on the balance sheet called computer equipment. Let's hit save and close. And sure enough, there's my $2,500 in computer equipment. Checking account balance is now down to $8,500. There should be absolutely no change on the profit and loss. And there isn't. All we've done so far on the profit and loss is we invoiced somebody, got paid, we earned $10,000. It's the only thing that's happened on the P&L so far with everything that we've done. Almost done here, folks, so bear with me. And again, I'll remind you, if you've gotten to this point and you haven't been practicing doing each of these by pausing the video and going and catching up, I would encourage you highly to pause the video or even reverse the video, right? And go practice this stuff. You're not going to learn it by just watching me do it. You're going to learn it by doing it along with me. That's the way. And especially if you feel like you're lost, it's probably because you didn't stop and do that. So definitely pause this video, go practice what you're learning, and then resume the video. Do one part at a time. Come back and spend some more time on it tomorrow if need be, just so you can absorb this in bite-sized little pieces. I'm giving you a lot in a single resource here. So we bought a computer last transaction. We're going to get some software for the business, right? So now we're going to see an expense account. We're going to finally see something happen on the profit and loss again, because if we go to the account types, right, my internet applications, which is what I usually call my software, because most of my software is SaaS software, which means it's running on the internet these days. So we're going to debit an expense for, how much was it? $150. We were going to pay for some software application. Remember, these things are usually monthly, right? We're paying monthly software fees. So I'm going to debit an expense for $150, and we're going to credit the asset, bank account, or cash for $150. So we're going to reduce the bank account, right? Because remember, if it's increased by debits, then it's obviously reduced by credits. So we're going to reduce the bank account by crediting it, and we're going to increase an expense account by debiting it. Let's get to work here. First, let's go to our T accounts and record it there. Right, so we're spending $150 in cash. Let's go transaction number 5, $150. Okay, and now I need to see if I have an account for software or computer applications or something like that. And if not, we'll just commandeer one. Here, we'll use that prepaid one for it, because I don't think I see it there. We'll call this Internet Applications. That's what I like to call it. And transaction number 5, $150. Let's go make sure we're balanced. And we are, right? There's my internet applications. As you can see, these titles here in my trial balance are tied directly to those T accounts. It makes it easy to play around and update and do things. And I encourage you, especially if you're just starting out learning, to do it like this. Go put it in the T accounts. Make sure you have the right expectation about how it should impact things, then go record it in QuickBooks Online. Yes, it will take you some more time up front, but it'll make you so much better at doing this stuff as you go. You'll get to a point where you can visualize it in your mind, and you don't need to go through this exercise as much anymore. But use this. I'm giving you a template here that I should probably be charging $150 for, and I'm giving it to you for free. So let's go record this in QuickBooks. We're paying $150 for a software application. Over here to the Quick Create, we're going to record another expense. And remember that when we recorded the fixed asset before, it wasn't really an expense, but that's just nomenclature in the software application here. They're not going to give you a million drop-downs for every kind of version. An expense really means money's going out of an account somewhere or going on to a credit card somewhere, because notice here you can use either bank or credit card accounts. Okay, so we're paying for software. Let's call it, let's see what I have for vendors. I don't even know. I didn't really think about this. I don't have a whole lot of vendors on here. Here, let's pay Intuit. That's not Intuit. That's not what we would use for this. All right, I'm just going to create a new vendor real quick. All right, some software vendor. Very, very original stuff. Save, and now you see how easy it is to just, like, you don't get stuck. If you have to get something recorded, QuickBooks Online makes it very easy to do that. Let's see if I have my internet applications. I don't, so we're going to add it real quick. It's going to be an expense account. This I'm not going to worry about too much. Save and close. So if you don't have the account you need, you just saw how easy it was to add on the fly. If I went a little too fast there, I apologize. It's because I'm not really teaching you how to create accounts in this video. I'm trying to teach you the basics of bookkeeping. But please pause it, rewind, so to speak, and then replay it if you need to see exactly how I did that. But rest assured, it's going to walk you through it very easily. When you choose the option to add the account, because it's not there in the list, it's just going to bring up a dialog where you're going to tell it what kind of account is it. In this case, it was an expense account. And there's a detail type you have to assign. So I just chose a general office and administrative kind of account for this as the detail type. Not that important, the detail type. So when I record this, we're going to see money come out of the bank account. This is the account that's being reduced. This is the source account of the expense. This is the target account. This is the expense account that's going to be increased. So I'm going to reduce an asset, cash, on the balance sheet, which is the bank account, and I'm going to increase an expense account, which is on the P&L. We're going to finally see an expense here, so our net income will then be 10,000 minus 150, which will be 9,850, right? So let's save and close. Cash has been reduced to 8350. Net income 9850, just as I had predicted. Everything worked exactly as it should, and that concludes our 5 transactions. Now, one thing, if you wanted to kind of review what we did, you can actually, of course, click into the bank account, and you'll see each of the transactions I've recorded here that impacted the bank account. Right, $1,000 I put into the business, $10,000 I received. Right, what's missing from here is the invoice, because the invoice didn't impact the bank account. The payment I got on that invoice did. $2,500 payment into computer equipment, a fixed asset, misspelled equipment, and then I have $150 that I spent on internet applications. My friends, this is a free half-an-hour video on bookkeeping basics with QuickBooks Online. As always, I know you will post your comments below because you're always so good about doing that. Please share this video, tell all your friends, tell your family, your mother, your father, your daughter, your sons, everybody you can think of who might benefit from watching a video like this. And please take advantage. If you're watching on YouTube and you're wondering how to get the template, check the description. There's probably going to be a link over to the blog post, which is where I'll have the template link so you can get access. It is a Google Sheets template, so when you get it, it will be view only. Some of you are going to request access, and I'm going to reply with the very same instructions I'm going to give you now so you can save yourself some time. If you pay attention just about 30 more seconds here, click File, and you can either make a copy so you can work with it in Google Sheets as I have, which I highly recommend, or you can download as and choose Microsoft Excel. You probably don't really want this in a PDF format because you're not going to be able to make updates and changes to it and follow along. So I would make a copy and then save a backup so you have the answers here, right? And then make a copy that you can work with, blank it all out, and get to work, practice, follow along with the video, post the transactions as you're following along with the video, pause the video, go practice each of these transactions. Make sure you can get the same result. I guarantee you your bookkeeping capabilities just on doing this exercise with these 5 transactions will increase dramatically because you'll have a real clear and thorough understanding of exactly how what you're doing is impacting the results of what you're doing, which really, as I said in the beginning, are the financial statements that describe the financial position of the company. That's it, my friends. Bookkeeping Basics with QuickBooks Online. As always, I hope you're having an absolutely fantastic day. I hope you learned something here and had some fun along the way, and I'll see you in the next video.